Hello, it's Jonathan Wellham of ROCKLINC Investment Partners, and it's Sunday, August the 24th, 2014. Now, I trust your summer has gone well, if you're anything like me, it's hard to believe that we only have 1 week left in our summer. Hopefully, September will be nice and warm and give us at least a psychological extension of the summer before the winter comes upon us. Now, I want to talk just briefly about the central banks in the world, and in particular, the U.S. Federal Reserve. About a year ago, the Federal Reserve said that it was going to start to cut back on its money printing. And as many of you know, there's been about 4 different episodes of money printing on the part of the Federal Reserve in the United States. And this last episode was called QE4, or Quantitative Easing 4. And about a year ago, the Federal Reserve was actually printing about $85 billion per month of new money, just sort of stoking the system, pumping it into the financial system in the United States, in particular in the banks. And that's a lot of the money that's gotten also into the stock market and propped up stocks and taken bond yields down in the situation that the money's been chasing bonds. But about a year ago, they said they were going to start tapering. That means they were going to start to cut back on their printing of money. And so a year later, we're at the time now where that printing of money has gone from 85 billion down to 25 billion per month, and it should be over with around October, November of this year, so in the next couple of months. So they're going to, again, their plan is to stop printing the money that they have been the last number of years, really since the financial crisis began. And that's led to the whole speculation of when are interest rates going to actually start going up again. And so this is important, especially as you're an investor in financial assets. And what we find quite interesting is that as we're getting near the end of tapering and there's more interest rate increase talk, the market has actually been taking interest rates down. And this has really surprised a lot of people, including ourselves to a certain degree. I would have expected rates to start to edge up as you get the central bank coming out of the marketplace. And also with the idea that rates are going to eventually have to come up a little bit. But what the market is looking at is saying that if there isn't all of this stimulation on the part of the central banks, what's going to happen is we are going to potentially fall into a deflationary world, a deflationary situation. And so we have a couple of charts that we're going to hold up for you to look at. And the first chart actually just shows the 10-year yield of the United States, the U.S. 10-year yield, along with the Spain 10-year yield. And we put Spain up there because this is one of the countries that is in terrible financial position. It's one of the peripheral European countries. But if you look at this chart, which just goes back to July 2012, you can see that the Spanish yields have really moved around, even up to a high of 7-8% on their 10-year, all the way down to about 2.4%. And if you look at the U.S. 10-year yields, you can see that they've bounced around 3% or so, and then down below 2%, and then back up above 2%, and currently are sitting around 2.4%. Now, the interesting point there is that the interest rate you earn on a Spanish 10-year note, government note, is actually slightly below the 10-year yield on a U.S. Treasury, which is really quite shocking. Because if you think of the risk of investing in Spain, it would be far riskier than the United States. And so you can see the yields coming down more recently there in the peripheral. Now, the next chart I'm going to just have put up there looks at the German 10-year government bond yield. And this goes back to 2007 and then takes you forward to the current position or current time. And you can see that yield at back in 2007, 3-4%, has now dropped below 1%. And you can see that drop in the last number of months, which has taken it from almost 2% down to 1%, less than 1% on the 10-year. In fact, in Germany, anything less than 2 years is trading at a negative value. That means you invest in the bond and you get less back in 2 years. And that's not taking advantage or factoring in inflation. And then the next chart I'm just going to put up there looks at the long-term German bond yields, and this goes back 200 years. So it takes you back to 1815 and then takes you forward to 2014. And the point I want to just draw your attention to is that Germany has never seen bond yields as low as they are today. And so these yields really, really have come down. Now the point here is this is really counterintuitive in one sense, but if you think through the logic of it, it actually makes a great deal of sense. The market is now telling us that if the central banks stop with their money printing, if they stop with their easy monetary conditions, and they start to put rates up a little bit, that the economy will tank and asset prices will drop, and we will see deflation, not inflation, similar to really a Japan world. And if that's the case, then 2% interest rates and 1% interest rates are actually attractive because inflation will go negative and we'll see deflation. Now, we look at that as investors, and we really are in some cases not really surprised that would be the case, because as we've talked about before, there's just way too much debt, and the debt is not supportable by a normal economy. You've got to ultimately have it being pumped up by central banks. And if we go back to an economy without central bank involvement, we can expect, and we should expect actually, deflation, and we need to be prepared for that. Our suspicion is that as the central banks pull back, that economies will weaken, which is what we're seeing all around the world, very weak economies. And that will then prompt the central banks to step back in again, because the central banks do not want to deal with reality and ultimately the pain that must come at some point. And so from our perspective, we have to be prepared for the fact that the central banks might just step out and let things deflate, if you will, or might step back in again, and that will then lead to much more aggressive inflation. The market's not seeing that currently. And so how do you position in this environment? I guess it really gets down to the issue of how do you position, how do you prepare for this? And I think from our perspective, we're trying to prepare for both these potential events, that the current situation is not sustainable. And either we will see a deflationary situation where asset prices come down, and you really want to make sure you're invested in the highest quality companies with the very best balance sheets, and you're as far away from just paper assets as possible, because those could get wiped out fairly quickly. Because if you have asset prices dropping, banks will not have the proper collateral to support their loans and mortgages, and that will cause a massive problem with the banking and financial system. Or you're going to get into an inflationary situation where paper assets will be worth less and less, and real assets will be worth more and more. So either way, we believe in the next 6-9 months, as central banks try to extricate themselves from this massive intrusion into the market that we've seen, expect choppiness, expect volatility. But in the end, quality assets, hard assets, oil, gas, water, agriculture, infrastructure assets, precious metals, companies with wonderful balance sheets will survive, and ultimately, in many cases, take advantage of weak competitors. And so this again is another reason why we really emphasize being invested in high quality assets and not being complacent in regards to the lack of volatility and sort of the way the market has progressed over the last number of years. This is ultimately going to lead to a lot more volatility. And we're prepared for that with the sort of high quality assets that we're invested in. So pay attention to the Federal Reserve, pay attention to this tapering, watch interest rates, because the credit markets are telling us that deflation is more probable right now unless we get another round of monetary conditions by the central banks where they step back into the marketplace. So hopefully that provides you with a quick little update in terms of central bank policies, some of the interest rate changes, but in the end, we want to just reaffirm to our clients that we are focusing on the highest quality assets and are prepared and actually looking forward to a little bit of volatility so that we can take advantage of changing prices. Thank you very much. If you have any questions, please do not hesitate to call us, email, or stop by the office. Thank you very much. Bye now.